You just took over as CEO, though we've spoken just a few months before that. I want to start with what Carol mentioned in the macro, because we are just squarely focused on an increase in oil prices as a result of the war in Iran, what that means for consumers, what it means for business leaders. How are you looking at the macro environment?
Yeah, well, first, thanks for having me. Great to be here with you, too. I look at the macro environment right now, and I think about all the chaos and turbulence our customers have been through going back to COVID. Mm-hmm. 6 years ago, the world was shut down, right? Over the course of these 6 years, think of all the geopolitical events, post-COVID, the rate hikes and how that impacted our customers. And I actually look at these customers and I realize they've built a lot of endurance. They actually, this turbulence is more of a feature of the environment that we're living in today. And I look back to a conference where we were talking to investors a couple weeks ago, actually right after the weekend of the original Iran bombing. And we were telling our customers 2026 started really strong. 2025 was our second largest leasing year ever, and we were seeing that go into 2026.
Does that continue? There's a lot that's happened. Like, it's just, I think, kind of shocking, and we talk about this so much. No one expected some of the things that have come at us, Dan, in 2026. So since that was just a few weeks ago or a month ago or so, that update, and that you were talking with, like, is that optimism still there? And is your outlook on 2026 still the same?
So what we see at this time is customers don't necessarily pull back. I look back to last year at this time, we had expressed a little caution that led into what was Liberation Day, right? And you see customers just look around and see what's going on and then lean in. They make long-term decisions, 5, 7, 10-year decisions when they're working with us.
Right.
And so they're really kind of seeing through that noise. And when you look at these decisions they're making, it's really only 3 to 5% of the overall cost of the supply chain.
So no people who were maybe going to sign a contract that backed out or anything like that?
Well, we hadn't seen that.
Okay.
And it's really just a matter of they digest it and then it comes in different forms. Maybe you end up seeing some short-term leasing, but certainly no pullback.
What about when it comes specifically to data centers? Because last time we talked with you about the data center activity you're seeing, and in that time a lot has happened. We've heard from different companies. Microsoft is renting a Texas data center that was dropped by Oracle and OpenAI. Are you seeing any signs of weakness or slowdown or changing trends when it comes to the data center business?
So our data center business was really born from our higher and better use business. When you have 6,000 buildings, 14,000 acres of land, close to 78% of the world GDP, that is where the next wave of the economy is. That's where data centers need to be. And we have deep relationships with these hyperscalers. We have a fortress of a balance sheet. And every megawatt we can deliver over the next 3 years is in some sort of lease discussion right now. And we have 5.7 gigawatts of power that we control or are in its advanced stages.
Meaning you're at full capacity in terms of negotiations right now?
We're at full capacity.
So nobody else could come to you right now and say, we're interested in the next few years, and you have an option for them?
No, that's not the case. Just the next 3 years of power that we can deliver.
Right.
These hyperscalers, these major data center users are heavily focused on near-term power, and we're focused on delivering power much longer beyond that. And so we're certainly in discussions beyond that next 3 years, and that's where this 5.7 gigawatts of power will come in.
So that's the power you've secured, right?
So we've secured 1.8 gigawatts,
okay.
And then we have 3.9 gigawatts that we call in the advanced stages, which means it's a year or two behind.
Okay.
But again, think of the universe of opportunities we have behind that 5.7.
You have,
the opportunity. Which is just the size of our platform.
All right. So then I'm going to say, are you looking to secure even more power?
Absolutely.
Yeah.
We are working, and remember, we're a global company. As you said, we're in 20 countries. And so we're working around the tier 1, tier 2 markets in the United States. We work around the FLAP-D markets in Europe, and we're starting to see it actually in Latin America and Japan as well.
So has anything changed because of the war, or is really everybody kind of looking through this? Because we talk about an energy environment, we've talked a lot about LNG specifically because Qatar's lost about 30% of their capacity, and that's going to take 3 to 5 years to build. There's going to be a floor where energy prices are higher. And so I'm just curious, has any of that impacted you guys in terms of how you think about outlook, build, spend, costs?
Well, as it relates to logistics real estate, again, it's 3 to 5% of the overall costs.
Okay, so
and our
it's not-
customers need to make these decisions long term, and they want to be close to those population centers, so can't necessarily sit back and wait.
Can I just throw one thing out there? This could be a little wacky, but it's Elon, and so that's kind of wacky. But we've talked this week, right, about data centers in space. Is that something you are thinking about and how that might impact you guys? Because you obviously are doing this on Mother Earth, and I'm just wondering, is that just something that
We're going to stick to these 20 countries that we're focused on. And,
no
on
Mars,
the ground,
Pluto,
I think,
Earth?
I think there's plenty of opportunity for us for the foreseeable future, but maybe ask me in 10 years.
Okay.
Yeah, I mean, but to Carol's point, why with that getting so much discussion right now,
Yeah.
why are you just focused on terrestrial? I mean, I know it would have sounded crazy a year ago to be talking about this, but this is something that a lot of people think is the future of these data centers.
Well, we do this business 100% on a build-to-suit basis. So we have leases in place before we put a shovel in the ground, and we have so much opportunity in front of us, we don't need to be thinking about another vector to grow this data center business.
Yeah, that's pretty fascinating. What would change your mind, though, in terms, would it have to be an economic slowdown, which some have talked about depending on when this war ends, or even if we see inflationary pressures continue and whether there's demand destruction that slows down essentially the global economy? A lot has to fall into place, as you know. Is that what would maybe change your outlook? Or again, because everything's locked in place, if the economy slows down, what kind of impact might that have on you guys? Or it doesn't matter because you've already kind of signed things and are moving ahead because it's longer term?
When I think about our core business,
Yeah.
if you think about the building blocks for our core business is 70% of the U.S. GDP is consumption. Our buildings are close to the major population centers in the United States. So on top of that, there's the e-commerce secular demand driver. We've been talking about e-commerce for a long time. Pre-COVID, e-commerce penetration as a percentage of retail sales was in the 17-ish% rate. Now it's like mid-20s.
Mm-hmm.
We see that growing another 75 to 100 basis points a year through the end of the decade. That alone is additional demand on top of that. So there's a big tailwind for our growth.
So, but if there was an economic slowdown, that could be a problem.
Well,
Or would that not even impact? That's what I'm trying to
one thing
figure
I
out.
forgot to mention is
Yeah.
with e-commerce, for every dollar retail sales, it needs 3x the warehouse space. Because think of all the activities that happen in the brick and mortar, and the returns happen there. There's the stock in the back.
Yeah.
And then with e-commerce, there's been that proliferation of SKUs. And all of us, we're looking for speed and we're looking for choice,
Yeah.
right? And so that's been a big driver. And you may see flat retail sales, but you'll see e-commerce penetration. That
still good.
e-commerce penetration is great news for logistics real estate.
On that, I'm interested in the joint venture that you guys announced last week, $1.6 billion JV with GIC to build-to-suit warehouse development. Why partner with GIC? Why not do this solo?
Well, we've long been developing on our balance sheet, but now look at our development business. We can build $43 billion more of logistics space in our land bank alone, not buying any more land. On top of that, we have this data center business.
Wait, say that one more time. That's tremendous.
So we have $230 billion worth of AUM today at the end of last quarter.
Yeah.
We can build another $43 billion of logistics buildings on our 14,000 acres of land.
Yeah.
That's 240 million square feet. We can grow the company 18% without buying another piece of land. Then we have this data center business. Think about it from a megawatt perspective. If you build a powered shell, that's on the continuum, powered shell over here, that's about $2.5 to $3 million a megawatt. You go out this side of the continuum, and that's a turnkey. That's everything soup to nuts built out. That's 15 million a megawatt. So think about how big that data center development could be. So we're looking at diversifying our capital stack there, and our partners. Great to have a new partner with GIC here. Yeah. They want a piece of this development business, and when we're doing that to help build bigger relationships globally.
It's a shame you're not optimistic.